If you follow the markets online, you're no doubt going to have seen this. When the markets take a drop, you're going to see a bunch of investors running out with glee and just buying the dip. Regardless of what's happening out there, that's just something that they get all excited about. The concept, of course, is based on the belief that if you purchase stocks during a temporary decline, you can generate strong returns once the market rebounds. That is true, but the kicker here is it can be effective under certain circumstances, but it's not a guaranteed path to profit. A lot of people sort of forget that part. In this video today, I'm going to discuss why you should be cautious and not automatically run out every time the market takes a drop. I want to start with the fact that when a price drops, it might be because the company may be having some fundamental issues. Now, obviously, a company's stock can dip for various reasons. Some of them might be deeper, more troubling issues than just a temporary blip in the share price. So before you go and buy that dip, it's crucial that you understand the underlying causes of the decline. And then you have to gauge whether these issues are likely to persist or in fact, even get worse. Now remember, a dip could be due to underlying financial problems. I'm going to cover a few of those off right now. First off, you may have poor earnings reports or declines in revenue. And a single poor earnings report, that might not be cause for alarm. You might go out and buy in a dip there. But if you see consistent underperformance, that could indicate a longer term problem. It's essential. When this happens, you assess whether the company's difficulties, the periods they're going through now, are due to temporary factors, or is there a more permanent shift in its market or perhaps in its operations? Secondly, leadership obviously plays a critical role in a company's success. So a sudden change in top management or questionable strategic decisions by any team of management can unsettle investors. That can lead to stock price declines. So when that happens, again, you need to evaluate the new management's track record, the soundness of their strategies before you write out and buy the dip. Thirdly, you may see increased debt levels, poor cash flow. And these are things a lot of people don't necessarily get to this depth, but you may have companies with high levels of debt or cash flow problems that are at a greater risk during, for example, an economic downturn. They might be doing fine right now, but when the markets turn, they're not going to have the stability there, the backing to work their way through that. When we see these issues, that can lead to insolvency or the need for a restructuring, which obviously can have a pretty severe consequence for stock prices. And lastly, on this topic, you may have companies that run into legal troubles or regulatory challenges, and that can have a huge impact on a company's operations, on their profitability. And before you go out and buy, you need to understand the potential financial or operational impacts of these issues if you're wanting to make informed investment decisions. A couple of examples here. First of all, I go way back to 2001, and I think back when Enron's stock price fell dramatically as its financial troubles became public. As it turns out, the company, of course, was using these complex and illegal accounting tactics to hide its debt, inflate its profits. Then when the truth came out, Enron, of course, declared bankruptcy. The stock ended up being worthless. There were still a lot of investors. The size of Enron, the blue chip nature of the company, a lot of investors still went out and bought this dip based on the past performance, just thinking or maybe hoping that everything would be fine. But the fundamental issues took the company down. Now, another example, which is more current, this is TD Bank and all the legal and regulatory challenges that they're facing these days, including the investigation that's related to money laundering oversight in the US. Now, we have seen the stock underperform in large part due to the unknown outcome of the legal issues and potential fines. So if this pullback is temporary, that's going to be fine, but will it have lasting consequences for TD? I think, of course, is the reputational damage that a company like that could have. So when these types of things happen, you have to use your own judgment. But again, these are the types of things that you need to think about before you just rush out and buy more shares just because the market is down. So having a company having fundamental issues may be a cause for a dip. Now, a second thing I want to look at here that might not be top of your radar are sector-wide problems. And sometimes a stock's dip is less about the individual company itself, maybe a good company, but there may be broader issues that are affecting the entire sector. And when you invest in a scenario like this, without understanding the sector-wide challenges, of course, that can lead to poor investment outcomes as well. For example, there can be external factors that affect entire industries, which then lead to widespread stock declines. It's essential in this case that you're able to distinguish between an issue that might be company specific and something that may have broader sectoral challenges. First off, you have to look at any structural changes in the market that's affecting all of the players. Long-term changes, things like technology changes, regulation, consumer behavior that can disrupt entire industries. In these cases, that you could have a company that fails to adapt to these changes. They may struggle to survive. Their stock price is obviously going to suffer as a result there. Also, rapid technological advancements can render a sector's existing products or services obsolete. Companies that aren't able to innovate, keep pace with technological changes, may see their market price drop, profitability decline. Changes in consumer preference can also have a significant impact on companies. If we look as an example, there could be a shift towards healthier lifestyles that could negatively affect the traditional fast food chains, while companies more aligned with the trends might benefit from that. And we see all the time these fast food companies trying to position themselves as less unhealthy, I guess you would say. And then we have the economic factors that would, of course, affect an entire sector. Things like fluctuations in interest rates, commodity prices. They can have a broad impact on an entire sector. Things like banking, real estate, energy. So companies that are heavily reliant on these factors may see their stock prices dip in response to some unfavorable challenges. A couple of obvious examples that jump out to me are in the late 2010s, we saw the decline of coal stocks. And at the time, all the coal companies were going through severe challenges due to increased regulation, increased environmental regulations, a shift towards renewable energy. We saw major coal companies like Peabody Energy, which is one of the world's largest coal companies. They saw their stock, plummet pretty much, ended up filing for Chapter 11 bankruptcy protection. So investors who bought the dip, that they were expecting sort of a quick rebound again from this large blue chip company, they obviously weren't happy when the entire sector continued to decline, and Peabody went along with that. Another example, in the traditional retail space, if we look back to the 2010s, that's when we started to see the rise of e-commerce, and that had a big impact on the brick and mortar stores, led to declines of many of the companies that operated in that space into their stock prices. The poster child there, of course, is a company like Sears, which struggled to adapt to the new retail landscape. It ended up filing for Chapter 11 bankruptcy protection, and Sears at the time, or in the 80s, was the largest retailer in the United States, and today it has 11 stores left. So, you may have been buying this blue chip company on the way down, expecting to recover, and of course, that didn't come to fruition in this case. Now, if a sector itself is having big problems, it might not matter what you own. It might just be a victim more to the bigger picture at all. So you might own a good company, but just the space it's operating in isn't the best place to be. The dip could also result as just an effect of broader economic concerns, and these can have a pretty strong impact on stock prices across the various sectors. When this happens, you need to have an understanding of the macroeconomic factors if you want to make informed decisions, which of course is why we're all here. Then I think of events like recessions, financial crisis, global pandemics that we've been through. Those obviously can lead to widespread declines in stock prices. And as always, investors need to consider whether these issues are temporary or indicative perhaps of a longer term economic problem. We have things like higher inflation, rising interest rates. Those obviously can reduce consumer spending, increase borrowing costs for companies. That can lead to lower profits, declining stock prices across many sectors. Now, another one that jumps out at me is geopolitical tensions. And we have things like political instability, trade wars, and international conflicts. Those can create uncertainty in the global markets. And this in turn then leads to increased stock volatility, price declines, even for companies sometimes aren't directly involved in the conflict. Changes in governments, policies, regulations. If you have new policies, new regulations, those can have a pretty significant impact on certain sectors. If we look, for example, at changes in healthcare regulations, those can affect the pharmaceutical companies if that's something that you own. It might not just be a blip, it may be a more systemic problem. Changes in environmental policies obviously can have an impact on energy companies. And this is really playing out pretty big time right now in the US. And we have the Trump versus Harris presidential race, at least as it stands today. A big wild card there would be the energy sector. So do we have, big oil or clean energy companies that would benefit from, depending on who wins there? Also, the healthcare sector is a big wild card there. Increased regulation, expanded access to healthcare. Those are all things that you might need to assess whether the companies that you're looking at in particular are affected by those rules. Finally, on this topic, a slowdown in global economic growth that can reduce demand for goods and services. Obviously, that in turn leads to lower revenues, lower profits for companies, which then sort of results in a widespread decline in stock prices. Yes, I would say no global slowdown is going to last forever, but it's something that you do need to be mindful of. Most obvious example that would jump out to most of us is the 2008 financial crisis. And of course, we saw a lot of companies across pretty much every sector back then. We saw stock prices drop pretty sharply, again, due to the broader economic downturn, not necessarily anything specific to that company. Mind you, we did have financial institutions. Lehman Brothers comes to mind. They failed due to exposure to subprime mortgages. And then, of course, as an example of there was a big systemic problem, but also very specific to Lehman was the way they were managing their company there. So hope a whole bunch of you watching this didn't go ahead and buy the dip there. Of course, they're no longer in existence. Now, obviously, there are lots of stories of investors who bought the dip during the initial stages of that crisis. And then, of course, they often faced further losses as the market just continued to fall. Now, the fourth area I want to look at here is the fact that technical analysis may signal further declines. And when we think of technical analysis, and we don't cover it a lot on this channel here, but that involves using historical price and volume data, for example, to forecast future price movements. And investors will often use technical indicators to identify potential entry points, potential exit points in the market. I use them myself to make final decisions on whether I'm going to invest in a company at a particular time once I've done my fundamental research on that. Now, when technical indicators are signaling further declines, even if a company has dipped, it may be wise to hold off on buying on that dip. The most common that people are going to use that you're going to hear are things like moving averages, the RSI, Relative Strength Index, the MACD. These can help you identify whether a stock is likely to continue declining. Of course, nothing is for sure, but they can be a signal. If you see bearish signals from these indicators, you might want to consider just some extra caution before you go ahead and make a trade. There are lots of these signals you can look at. You can look at other momentum indicators, trend indicators, volume indicators, whatever works for your flow, whatever kind of time and energy you can put into it. It can help avoid times when you might be tempted to buy the dip, but a little bit of analysis might help you make a better decision. As an example here, you might be looking to buy a company, but when you look at it, you see that the stock's price has fallen below its moving averages. It often indicates somewhat of a bearish trend, and this, of course, can signal further declines, especially if you have the crossover patterns like, the dreaded death cross. If you see those, also high trading volumes during that decline might give a more indication that they are under strong selling pressures, and typically you're going to see high trading volumes during a dip. That will indicate that a lot of investors obviously are selling. That can lead to further declines as well. Again, this might be a sign of a strong selling pressure, the potential continuation of a downward trend. You can look at support levels being broken. They can indicate potential further drops. So when a stock breaks beneath a key support level, it often leads to further declines. This is mainly psychological. These support levels sort of act as psychological barriers. Breaking through them can trigger additional selling. I mentioned RSI, and RSI below 30 is often considered to be oversold. It can also indicate, though, if you're not careful, that a stock is just in a strong downward trend. In cases like this, it may be better just to wait for confirmation of reversal before buying. An example I look at here is if you go back to 2017, you look at General Electric, and it started at that point a long drawn-out decline in its stock price due to a number of factors, including they had poor earnings, they had management changes. There's a lot of concern over the debt levels the company was carrying. Now that drawdown continued until late 2020. So during this time, if you look at GE's 14-day RSI, it slid below 30 a number of times. And often this would be an indicator that people would just jump in and buy based on this metric alone. But despite the RSI, looking at it like it was an oversold condition, it looks like you might want to go out and buy some. The stock kept going down. Now, another great example here is Ford in 2018. This example is going to sort of combine the RSI and a moving average. Now, at the time, Ford was facing a number of challenges. They had declining car sales. They had rising costs. The trade war concerns were a thing then. That also led to a pretty strong drop in its share price. So, hey, run out and buy the dip, right, if you believe in the company. Well, in early July, Ford's RSI dipped below 30. Again, that could indicate the stock might be oversold, potentially representing a buying opportunity. But if you add the 50-day moving average, you can see that was still trending downward. It was quite a bit below the 200-day moving average, which suggested that the broader trend was still bearish. As you can see with history being a guide, the stock continued to decline through to the end of that year. And I show this example because it shows how if you combine an RSI with the moving average, it can provide a more comprehensive view of the market conditions, and it can help us as traders or as investors avoid potential pitfalls if you rely just on one indicator and jumping in rather to buy a dip too quickly. Now, lastly here, I want to look at the psychological factors and the emotional bias that comes into us as investors. And I've always believed, and I believe now, that investing is as much about managing emotions and biases as it is about analyzing data. Both are important, but psychological factors, they can lead to very, very irrational decisions. I've noticed this especially during times of market volatility. I want to look at a couple of specifics here. First off, if we talk about overconfidence bias, this definitely leads to irrational decisions. And overconfidence, this can cause investors to underestimate risks and, more importantly, overestimate their ability to predict the market movements. And this can lead to premature or poorly timed buys during a dip. Now, fear of missing out, something that we all suffer from time to time. This can push investors to buy stocks during a dip without fully understanding the reasons behind the decline. If everyone else is jumping in, people want to get in on the ride as well. And this obviously is just an emotional response that can lead to some ill-informed investment decisions. And confirmation bias, this is a biggie. Investors, naturally, as humans, we often want to look for information that confirms our pre-existing beliefs while ignoring the contradictory evidence that might be out there. Just because we already own a company, it doesn't mean that you need to go out and lower the average cost. I mean, we're going to hear all that time. And I'm a big believer in lowering the average cost if you can. You may feel pretty comfortable, but it's always worth having a quick look just to make sure that you're not buying something that is dipped, but may still have a long way down yet to go. Should you own bank stocks or should you own ETFs? I've got a video about that on the screen here. If you want to know about 17 TFSA mistakes that you've got to avoid, you can click here. Thanks for watching. We'll see you in the next video.